It really is just terrific to see so many familiar faces today. It's wonderful to be back. In fact, the last time I presented at a Resource Rising Star conference in Sydney was back in May 21, when our share price was $1.40. And as Paul just mentioned, we hit a new record high today of up to $4.52. I think it closed at about $4.48. So it's just been a terrific journey, and I'd like to thank you, our supporters, for really investing in us and supporting us during this process. And for those new investors, it's not too late to get on board, and I'm about to tell you the reasons why through my presentation. But what you're seeing in the industry right now is the start of a brand new cycle, the start of a new uranium cycle. What we saw last week was just a taste of what's going to come. Last week we saw the price per pound of uranium move by $4 in 4 days. Last night it went up another $1.70 per pound. So we're now trading at 67 US per pound, which is hallmarked back to where we were 12 years ago pre-Fukushima. The market has moved, and now's the time to really get on board. Within the industry as well, we're noticing that the same conversations are taking place as what I first experienced back in the industry back in 2006, 2007. Utilities are in denial. Why is the price moving so much? There's plenty of uranium around. On the other side, you're hearing the developers saying, jeepers, we're not sure we can get into production in time. We're not permitted. We haven't got our construction. We need to raise funds. Are we going to miss the boat? Will we be there to really capitalise on that high uranium price? We fundamentally believe that the price of uranium is going to overshoot in the next 1 to 3 years because of this perception gap. Those who say they can come on as development projects, can they come on? And this is the key. This is where new production's required, and that's where Boss Energy has been bringing the Honeymoon asset closer and closer to production. Fortuitously, the price has moved quicker than I thought it would, but our planning was always to be in production by the fourth quarter of this year. And fortuitously, we're on time, we're on budget for production by December, the first drum of uranium being ready by January next year or early February. So to date, we're on target, but it's really, the key to this is really market timing and having that first mover advantage. So we go through the slides, just a picture of the overall mine, it's there. Right, so it's really security of supply is what's dominating the industry. Where are Western utilities going to find that product? They are weaning themselves off Russian-based supply and Kazakhstan. Why? Because post the invasion of Ukraine, we've seen sanctions and logistical problems actually moving material through Kazakhstan, through the Russian ports. Those logistical problems created a lot of sort of nervousness and anxiousness for fuel buyers, particularly in those Western countries. So right now, Western countries, they're not waiting for official sanctions to come through. They're already weaning themselves off that supply. They're looking for friendly uranium countries, geopolitically stable countries, such as Australia, to provide that product. And that's where we come in. What we're seeing now is a bifurcated market take place. It's almost like East versus West, and that's where the real opportunity lies. In fact, it's the first time since the 1970s that we're seeing this type of risk occurring, and we're also finding that China and Russia are moving into Kazakhstan mining operations, creating further tension for Western fuel buyers. So that's where suddenly the market's turning. When last 2 weeks ago was the World Nuclear Association Symposium in London, my colleague Sashi Davies was in attendance. Sashi Davies is one of the top 5 uranium traders in the world. I've had the pleasure of working alongside her for the past 12 years, previously to this with Extract Resources. She was inundated with fuel buyers wanting to contract. In fact, she had 9 meetings in 2 days. And it just shows that's the market changing. This time last year at that symposium, we only had 2 or 3, and a lot of the others were saying, we're fine, we've got plenty of inventory. That's what's changed. They now need new supply. They're incredibly worried about getting resources from that sort of the Kazakhstan area. So takeaways from that WNA symposium, the World Nuclear Association, the key question is that perception gap. Can new mines now come in on time to fill that gap? And that's the big concern. And that's where projects such as Honeymoon have that first mover advantage. We are fully permitted. We took advantage of the market back in March 2021 to purchase 1.25 million pounds of uranium when the spot price was at 30.12 US per pound. So the total outlay with the Australian dollar in conversion, foreign exchange, was about 54 million. That's now worth 130 million. But the key point of that was we could see the market turning. But what often happens when new mines come closer to development is that they then have to raise additional capital and working capital for that first year of production or during that ramp-up period. We've already secured our inventory to provide that working capital through that first year of ramp-up into the second year. It's strategic. We bought it so during that physical ramp-up we can also negotiate with fuel buyers such that we can deliver into a contract if there is any delay in permitting. But it just shows that was the first part of the attitude of getting ready for production. In March last year, before the interest rates started to rise, we took advantage of cheap equity. We raised $125 million in 4 days to get the mine, also to supply all our CapEx requirements. So we're fully funded now to bring it into production. Also, we've really approached the market very strongly to recruit the right body of people to take this mine forward, which I'll get to. So that's the question, where are these mines coming from? What's also recognised in the industry is that an incentive price of 80 US per pound is needed now to actually encourage new development. It's that price. So if you think the current uranium price is 67 US per pound, there's only one way. It just has to go up. So that's on the one side. The other side is that inventory levels are now very, very low. What we've found in the last 3 to 4 years is that fuel buyers and utilities, particularly in the West, have been burning more uranium than they've been stockpiling. You can't simply turn a nuclear power plant off or on. You need at least 1 to 2 years of physical inventory. And as I'll show you on the next slide, we're now approaching historic lows both in the US, America and the EU. They need to start contracting. Then, of course, in addition to fuel buyers, the industry, we've now got financial players entering the market. You've got the Sprott Commodity Trust. They're trading at a premium again. They've been out of the market since March of this year. They now have 50 million in cash ready to deploy. You've got Yellowcake, which is another physical uranium fund based in London. They've got 50 million pounds. And now we hear at the WNA symposium 2 weeks ago that there's a new Singaporean fund coming onto the market that's got a cash flow of 5 to 600 million US, also wanting to buy physical uranium. So these traders will come in and start front-running the market, meaning that the utilities then have to play this game of cat and mouse trying to catch them. And that's what's going to put pressure on this uranium price. All the while, they're looking for new product. Where's that production going to come from? That's why we're bringing Honeymoon into production. So inventory levels at all times low. On average in the US, you've got about 28 months of cover. Again, 2 years is the minimum deemed for these plants. You can't turn them on or off. In the EU, they're a bit more conservative at 36 months, but these are at lows back to 2012. That new product's needed. And post-16, 17, those, as I was mentioning, those European and US utilities have actually been burning more product than they've been buying. They've been a bit relaxed with the low uranium price, thinking it could go on. But then, lo and behold, we had COVID. Then Russia invaded Ukraine. So that's why, and then more recently, we can see around the world that geopolitical risk. Berkeley Energia in Spain, the change of government didn't work for them. They didn't get a supportive government for uranium mining. 2 weeks ago in Niger, we had a coup there. Orano then took off its production, which is the French's main production arm. Plus, you saw Global Atomic also wind back because they couldn't raise their funds for CapEx. A few weeks ago, we also saw Peninsula Energy in the US have to scale back their production time frame. They were 2 months away from first production. They're now 18 months away because their neighbouring mine will refuse them the opportunity of using their drying circuit. So again, these geopolitical risks shake the confidence of fuel buyers. If you look at a nuclear power plant in terms of OPEX, uranium accounts for 8 to 10%. They can afford a higher price to contract with. Spot term prices, as mentioned, Sprott hasn't been in the market as a financial fund since March of this year. So what's been supporting that uranium price is actually fuel buyers, utilities. And now we're seeing that those, as mentioned, you know, the funds, those financial funds are about to come back into the market. Last year we saw 124 million pounds of uranium being contracted. Already year to date we're at 120 million pounds. And on an annualised term we think that'll go to 170 million. The utilities are getting spooked, wanting to purchase more. The increase in primary demand, we've seen a drop-off of about £44 million this year from previous forecasts. Cameco's also reduced their operating forecast, Cameco being one of the world's largest producers of uranium. Interestingly, they dropped it by £2 to £3 million per annum. Why did they do that? Because they couldn't find enough skilled personnel to operate their flagship mine, McArthur River. Now, that's one of the world's top producers of uranium. And it's quite, if you look then around the industry, it's a hallmark within our industry. The last 10 years of being in the doldrum, a lot of people post-Fukushima within the industry went into other commodities. We're in the doldrums for the last 10 years. Where are those companies going to find their people? Which I'll talk to in a second. But what we're also finding is that term contracts are increasing. And again, this is where that first mover advantage of BOS can really come into play. So we are fully funded. We've got 87 million in cash, absolutely no debt. Again, that physical uranium is now, well, it was 121 million when I wrote the presentation on Friday. It's now worth $130 million. So our balance sheets are strong, roughly 200 million in assets, and again, absolutely no debt. We're in the best jurisdiction in Australia for uranium mining, being South Australia. The only other two uranium-producing mines in Australia are based there, being Olympic Dam and Heathgate. We're destined to be the third, and for that purpose, Australia's next producer in the last decade. We can fast-track production up to 2.45 million pounds in 3 years. We've built a very strong team, operating team, that's got the experience. Being in South Australia, you've got access to the artisans, you've got access to wellfield operators, you've got access to those who can operate ion exchange and uranium plants. And then we've got significant upside. 50% of our JORC resource, about 36 million pounds, sits on the fully permitted mine licence. In addition to that, we've got another 36 million pounds on 2 satellite deposits that we're now proving up with infill drilling. So there's scope to also increase the life of mine or increase the production throughput, which is what we would like to do. We have an export permit in addition for £3.3 million, and to get an export permit in Australia effectively means that all your other permits are in good working order. There are only 4 operations in Australia with an export permit, the 4th being ERA, which is now being decommissioned in the Northern Territory. So it's again, those soft qualitative factors that we all sort of don't pay too much attention to in the doldrums of where do you get your people, are you in the right jurisdiction, can you get fully permitted, we can tick those boxes. We're very well strongly positioned to build a strong multi-asset platform going forward. Wyatt Buck's the chair. He's a lovely, modest Canadian. He's a mechanical engineer by background. He had his formative years with Cameco. He was one of their rising stars. In fact, this will be his 4th uranium mine he's commissioned. He was the executive GM of Cameco's flagship mines called McArthur River and Key Lake. In the last boom, he was then headhunted by Paladin. He saw their Langer Heinrich flagship mine from commissioning to nameplate. He built the Kalakira mine that's now with Lotus. And then he was recruited by First Quantum post-Fukushima to be the executive GM of their 9 global nickel projects around the world. He brought Jan Honeymoon into the team, which has just been wonderful. Jan had recently retired from First Quantum, where she looked over 14,000 people in 9 continents. But in terms of attracting labour and that skilled workforce is now so important in this industry. It is across the mining industry generally, but certainly within uranium, because there's just a lack of skilled talent. So she's been absolutely wonderful to work with and implement the right HR type policies. Bryn Jones was technical director for 2 years, chemical engineer by background. He had his formative years with the Heathgate mining operation, some 300 kilometres to our west. It's also in situ recovery and ion exchange. So very, very skilled in what we do. And for me, this will be the 2nd uranium mine I've commissioned in the last 8 years, the previous one being the Husab mine in Namibia, which is a £15 million per annum production. In terms of strong balance sheet, again, this is moving, the price is moving, uranium price is moving, our share price is moving, just even from last week. But what it does show you is a very robust balance sheet. Again, that physical uranium is there to supply us with our working capital requirements as we go forward into production, to avoid us the necessary of going back to brokers, raising more funds just to keep the project going. So we really de-risk the project, and it's all the while from the production guys saying, de-risk it because then we won't have too much pressure to shortcut during commissioning. Sashi, our marketing lady, saying it gives us a lot stronger negotiation skills with new utilities contracting because they've got the confidence that we can feed into our contracts if there is any delay on the project. So that was the rationale there. In terms of, there are just 4 key areas on the mine. We get our power off the grid from Broken Hill. We're just across the border there in South Australia. We've got our own plentiful groundwater reservoir. Water treatment plant, we're doubling in capacity. Think desal plant. Effectively, we're having to remove some of that salinity and gypsum such that we could run a cleaner lixiviant through the well fields to leach a high-grade uranium back to the plant. The main change, though, is these ion exchange columns. So what you can see there is a bird's eye view of solvent extraction columns, 2 of them in that framework. We're now looking to remove those and put in ion exchange. And then the drying circuit, we're putting in 2 new calciners such that we can heat the material to about 800 degrees Celsius to produce that U3O8 rather than UF4, which was the previous operation. So the world has also moved on in that product, but we've brought our capacity, we've looked at what do our customers want, we're giving them what they want, and we're taking care of all those plans now. So, progress at the moment, well, 87% of our CapEx has been committed within budget, and we are on time to deliver by December this year. We've got a strong, our wellfield installation's complete. In the next few weeks, we'll be announcing the flushing of the wellfield, which is the precursor to start mining and operating. Typically, that runs for about 2 months before production takes place. But essentially, those wellfields are constructed, the gypsum pond's been completed, the water treatment plant agitators we got working 2 weeks ago, and we've just got the energised the first train of the RO plant just over the weekend. So that's what's needed, the gypsum pond, the RO plant, the water treatment plant and the well fields to get the mining underway, and we're ready to do that. The first ion exchange column's been delivered. There are another 5 on the way. 2 are actually on the water. Resins for those ion exchange columns, the first batch is also on the water, which we'll take delivery of at the end of the month. Adelaide office is open. 2 transformers have been arrived on site, and our recruitment's going incredibly well. We went early, we picked up the right superintendents, managers to see this project through, and yeah, really proud to be in Australia pulling this, getting this project up and running. In terms of in situ recovery mining, what is it? It's the most predominantly used form of mining for uranium currently in the world. Why? Because it's the only method of mining that can operate cheaply at low uranium prices. So 60% of the world's supply of uranium currently comes from in situ recovery throughout Kazakhstan, Wyoming, Texas and Australia. That's the predominant method, and that's what South Australia is particularly known for its skill base in using. Effectively, it operates with a spot pattern of well fields sitting above the resource. You've got 4 injection wells, 1 extraction well. You take the pregnant leach solution that you've recovered through the ground, pump that to the surface, through to the ion exchange columns at the front end of the plant to then produce your U3O8. There's a picture taken quite recently of the first well fields that account for the first 2 to 3 years of production. They sit just adjacent to the actual processing plant itself. In fact, you can walk around the whole well fields and plant within about 2.5 to 3 hour period. It's a very small, intimate plant. No one can hide on site. It's actually, everyone's getting on incredibly well. It's a lovely mine to work on in that regard. It's not too big. It's very manageable. But those well fields are now connected, ready to go. You can see there the gypsum pond, which we had sort of 60,000 cubic metres of earth removed for that pond, which will last for the first 5 years. And then part of our team, well, we self-perform. So by self-perform, rather than do a typical EPCM model where you pay an additional 20-30% margin, we do it all. We do our own designing, engineering, procurement, contracting. In fact, our man hours year to date on this project of building is 95%, the rest being contractors. So it just shows that approach, and it includes this crane. So we purchased the crane for $2 million from Dampier in West Australia early last year. It's one of the largest cranes in Australia. There are 5 like this, 400 tonne. Already we've got offers for $2.4 million to buy that once we finish with it. But that's self-performed. So rather than paying an $8,000, $10,000 a day type rental fee, we just bought it, we'll sell it for a profit. And that's that attitude that this mine has as a team. So there you can see it's removing one of the solvent extraction columns. Here's the delivery of the first ion exchange column, and you can see the size of these fabricated fiberglass columns. And then there we're dropping the first column into the steel framework. So we're using the same steel framework as what housed the actual solvent extraction columns, and then we're going to add another 4 into them. But that's now 3/4 complete, and that first ion exchange column will account for the first 6 months of production. In terms of the water treatment plant, RO plant, there's the RO plant nearest in the picture. That first train's been energised on the left there. The second one will get up and running next month. And behind that, you've got the water treatment plant where the agitators are working, and now we're ready to start flushing the well fields. From a JORC resource, we've got £72 million, again, half of which is on the mine licence, half of which is on 2 satellite deposits, and then we've got an exploration aspiration of up to £190 million in addition to the satellite deposits. So we're now currently infill drilling on those satellite deposits. I've announced the results of Gould's Dam. Next week we'll announce the step-out drill results outside of that Gould's Dam resource, and then we're moving the rigs over to Jason's. But the whole idea, how are we going to organically grow this company through our own resources, through increasing the mine life and production profile. And there's some recent results that we announced in the Gould's Dam satellite deposit. Our announcement of a few weeks ago is actually stronger, but this in itself has got higher grade. So you're looking at GT, which is grade times thickness cutoff, so you're looking for a minimum of about 1,400 to establish a well field, but you can see there going up to around 20,000 GT, which is just fabulous to build a profitable well field. So very, very exciting in that respect of new deposits on new areas that we own 100% of. Financial highlights, as we heard in the previous presentation, once you get IRRs up above the 40%, 47%, you really know that you've got a compelling project. EBITDA margin 62%, fantastic returns, and also the low cash costs of production, sub 20 US per pound. Bearing in mind the current uranium price is 67 US per pound. To incentivise new production, they need 80. But we really believe the prices are going to overshoot in the coming years, and that's where we can take advantage. In terms of upside potential, we've got the feasibility study. You've got the value of that existing inventory that we house in the Confidine conversion facility in the US. We've got the mine life extensions through those satellite deposits. We're highly leveraged the uranium price, and we've got the ability to really focus on production and drive efficiencies. But the whole method of us, it's not just the organic growth. We're now going to start looking at M&A opportunity. We wanted to prove honeymoon first, get that up and running, produce a positive cash flow. Now look at tier 1 jurisdictions around the world, focusing on Australia, US and Canada to really grow this project further. We've got the team to do it. We've got a team that's actually built uranium mines, operated uranium mines and shipped uranium around the world. From an ESG focus, they're the standard sort of words that you see on the screen there that most mining projects are putting out. But what I can share with you is that 10% of our workforce have Indigenous background, Aboriginal on the mine. We really encourage our stakeholder engagement. Agnamantha, Willakali people, we really represent strongly. Our workforce is now growing to 20% female representation. We're really keen to grow upon those wonderful sort of factors and really encourage a local workforce with our stakeholders. But with that, thank you very much. And if you've got any questions, please send them through email. I'll answer everyone and happy to talk after the conference. But thank you.